I will introduce our today's guest, Yuriy Butsa. It's a pleasure to have you here again. You did this last year as well. And a few words about Yuriy. He is now the Government Commissioner for Public Debt Management. He is that since 2018 and has been that during the war. I think it's probably one of the most interesting jobs that exist in Ukraine or has been during the war, one of the most important at least. He has had many discussions with different governments who has supported or provided financing for Ukraine. And we are very happy to have him here today. His background before this position as Government Commissioner for Public Debt was that he was a Deputy Minister of Finance for EU integration. He became that in 2016. And before that, he was a commissioner in the National Securities and Stock Market Commission. And he has done also other things. And he's also a member of Supervisory Board in Ukraine Bank, I think. Yeah. So very welcome, Yuriy. We are very happy to have you here and to hear about a bit about the budget and also a bit about how you keep investor confidence for Ukrainian financings and a little bit about this restructuring that was done with the warrants. I think that is quite interesting. I have some questions related to that. So please, I give a word to you. Please go ahead.
Thank you so much. Thanks, Christian, for inviting me to speak here.
Sorry, Yuriy, I forgot one thing. I just have to add also, if people have questions, please, you can write them in the chat, and you are also welcome to raise your hand. We take all the questions after the presentation. So sorry about that, Yuriy. I just forgot to mention that to people. Please go ahead.
Absolutely. Thank you so much. And there was a comment in the chat that the sound is not good. So let me just double check whether you hear me well and there are no echo. I assume yes, right? Good. So maybe let's switch to the presentation then. Tatiana, if you can put it on the screen. Oh, perfect. I would be happy to guide you through where we stand now and what's the plans for the financing for the upcoming year. If you can switch to the next slide, please. So obviously financing the country in the times of war is a trivial task. Before the war, those who were with us and remember, we were trying to be as prudent as it gets. You saw even during the pandemic times, our deficit of 5.2% was really very high for us mentally, and we immediately, well, one of actually not many countries in this part of the world at least, we managed to go down to 3.1% of deficit immediately to have a proper fiscal consolidation in 2021, which actually resulted that our debt to GDP ended in the end of 2021 below 50%, so 47% to be precise, which was one of the lowest post-COVID recoveries, one of the lowest debt burden post-COVID in the emerging market in total. Obviously, war affects the public finance significantly. You see this chart is very representative in that respect because you see that majority of expenditures and the dynamic of those are war-related, which obviously results even with increase of the revenue collections and some reprioritization of all unnecessary expenditures. It results in the deficit north of 20%, and that's the new normal for us. And if you cannot control the deficit because of the war, you try to control all other parameters to make sure that the deficit is manageable and doesn't create long-term issues for the country and for the public finances. If you move to the next slide, you can see how the different parts of the budget reacted. So the revenue collection since the war started was gradually improving. So the first achievement actually of the government was to make sure that all the tax system works and that the just infrastructure works well. And we see that now we can observe that the tax collection improves both because of economy being stable since 2023. We had a sharp contraction of GDP in 2022 by almost 30%, but after that there was not a big rebound, but a steady growth, and that really reflected in the revenue collection. On top of that, the government obviously was working to improve the revenue collection through introducing additional taxation. We didn't resort to some of the options which would be natural. So we still balance the impact on the economy in general and the need of the budget to collect taxes. For example, we didn't touch the VAT, which could be an obvious choice in other circumstances to increase the revenue collection, but we introduced the military tax for private entrepreneurs, and then we're now working on a set of another tax measures to improve the revenue collection. I think we tried to communicate the necessity to this. Different businesses have different view, but we believe that the improvement of the revenue collection and more level playing field, which is even more important, is necessary for post-war recovery. So we have a package of tax measures we plan to work with the parliament on to introduce, which will, for example, try to make it harder to avoid paying taxes through using simplified entrepreneurs, because we believe that this is suboptimal. Then there are businesses who pay all the taxes, and there are businesses who compete with them and trying to avoid paying taxes through using the simplified entrepreneurs, and that doesn't create a right level of competition for the businesses. So that's one of the things we want to tackle. On top of this, the other one is that taxation on parcels, which is something which EU is doing now as well, and US already did, and that's to reflect on the deterioration of BOP through the increase of imports, and this is a measure which is actually now a standard in the modern world. In terms of expenditures, we keep all the social expenditures intact. We don't have a capacity to increase them, like to increase the salaries and pensions to the extent we wanted, and because of, once again, the military expenditures being the top priority for the budget. And that's result in the forecasted deficit for this year of 17.5%, which is still lower than the previous years, but we already know that in the previous years we also started with the lower deficit numbers, but because military expenditures is really hard to predict, and ad hoc military expenditures have a tendency to appear within the year. So we prepare ourselves for the fact that in case of need, we need to have a bit of headroom to increase the military expenditures and to have a financing attached to this. Let's move to the next slide, please, here. And so this is the description of this year's budget, how it looks for this year. You can see that the revenues are being healthy, and but the deficit is still there. So the deficit is roughly $38.8 billion in dollar terms as of now. And on top of this, we have domestic debt repayment, because the market is alive and is one of the important sources of funding. I will discuss this later. And we have small external debt repayments for this year. This is after the debt restructuring, the commercial debt restructuring Christian already mentioned. Those external debt repayments are solely to the international financial organizations, which have preferred creditor status and which are important lenders to us. So those debts to the IMF, World Bank are being served this year, but this number is much smaller. So pre-war external debt repayments was always a higher number than domestic ones. Now, with all the operations of both on the commercial front, when we restructured all the commercial debt, and on the official sector, when bilateral loans was put on the standstill, we managed to save a lot for the budget from this particular line, which And the deficit, as you see, the total, together with the repayments, results in 53.2 billion of total financing needs. The plan for this year is to cover it by $9.2 billion from domestic financing, and residual to be covered by the external financing, which is very similar to the previous years. The only difference here from the previous years is the fact that because of the possibility to get money from EU to cover the needs, and there is a 30 billion discussed and being approved already in the process of approval of the budgetary financing plus the military ones. So that amount of financing gives us the possibility to go down with the domestic borrowing. And contrary to the previous years when we were net positive, this year we anticipate to decrease the rollover rate below 100%, which gives us a bit of dry powder to react in case there will be a need to quickly supplement the liquidity and increase the borrowings. We hope it will not be the case, but the possibility to have a lower rollover is definitely helpful, because the domestic debt is the most expensive part of our debt composition, and that's why it's important for us to keep the debt service under control as well on that front. Let's switch to the next slide here, please. So in terms of financing, what I already started to discuss, you can see that contrary to 2022, when we didn't have a lot of financing, so all the financing on external front was on ad hoc basis, because we didn't prepare ourselves for the war in terms of having long-term financing commitments, and nobody anticipated this, right? So in 2022, the majority of funding was coming from domestic sources, including the monetary financing, which was a big part of this 697 billion number you see here on this chart. Since 2023, we came to the situation when we secured long-term concessional financing from the partners. I didn't have to go to the monetary financing route. And this is something which I emphasize in each and every meeting I'm having, especially with investors, that we are a country at war which doesn't print money, which there were no case, I think, in the last 100 years of this happening. The people resorted to printing money and to monetary financing in the times of pandemic. In post-pandemic, we are at war, but we are mindful not to increase the monetary financing and not to be in situation when that automatically fuels inflation. And you can see with the last inflation prints that the strategy works very well together with the monetary policy. The inflation is going to the single-digit territory, which is also unheard of in terms, if you look at the historic precedents of the wartime economies. So what we achieved here, actually, we have a rather stable, not ideal, but stable macro framework and equilibrium here, where economy still works, and the financing, the deficit is not having a huge spillover effect on the other economic parameters. Obviously, the needs for external borrowings are high, and that's why it's important to have all partners together aligned and on the long-term basis. I think we moved from 2022 to now, we moved a very long way in terms of how we ensure a long-term and very concessional financing. And let's move to the next slide. I'll comment more on this. So since the 2022, you can see the breakdown of the funding for Ukraine. So the biggest lender was European Commission. We put it as EU. In 2022, we started this through the regular macro-financial assistance. Then there was Ukraine facility of the 50 billion euros approved, out of which I think 33 is budgetary funding. That's something which is being gradually disbursed. And last year, we, together with IG7 partners, we implemented what is called ERA loan mechanism, which became an important source of funding for us. So this is a $50 billion instrument where all the repayments are being done by the Russian frozen assets. So that's the facility that actually just to demonstrate you how we approach as a prudent debt management and public finance management here. So this 38.9 billion already disbursement and total 50 billion to be disbursed has zero impact on the public finance because all the debt service is generated by the frozen Russian assets, which are predominantly frozen and immobilized in the Euroclear. So they generate interest every year, and that interest is going fully to repay that 50 billion facility, both interest and principal. The facility was a joint effort by European Union, Canada, Japan, US, and UK. And this is the backbone of our funding last year, and that's the key source of our funding. This year, as you can see in the right chart, so since the beginning of the year, we got already 3.8 billion of the funding from that source. The second biggest is still the domestic bonds, so that shows the importance of domestic market. Here we see that it's not only the liquid financial system which contributes to the source of funding, but also the private individuals and corporates who invest in this instrument. And actually, this week is the record week in terms of the private individuals holding of the domestic debt. We have the highest amount ever. And we see that is not only because people want to support the government, but domestic bonds is really a very interesting and rather profitable source of investment, both for private individuals, but also we see corporates playing a lot in this field as well, and we benefit from the situation in terms of the budget financing. So ERA loan, as I said, is the instrument of last year, but it's already third biggest instrument of funding for us. US financing was very important 22 to 24. Then it switched actually to ERA loans format as well. IMF mostly, so IMF is important source of funding, but mostly it nets out the repayment. What you saw on the previous slide, we are current on all the obligations towards IMF, and normally the money we get from IMF are being used to repay the loans to the IMF. So it's a bit of net positive financing, but not really a massive one. The monetary financing, as I described already for you, was used only in 2022, but still the magnitude was high. And then we have bilateral lenders who supported us in these turbulent times. For this year, on top of ERA loan and domestic bonds, we have already, you saw in the press, announcement of a new European facility, which we're working with our partners in Brussels to finalize and to be up and running in April. And on top of this, we have bilateral commitments from countries like Japan, UK, Canada, which we plan to utilize through the available mechanism within the year to have the fully financed budget for 2026. And probably let's move to the next slide now. This strategy of getting as long as possible concessional funding and on top of ERA, which I described, EU is using their own budgetary resources to compensate for any interest, and we try to get the funding on a very long and very concessional terms, so as close to grants as practically possible. So on top, so that means that despite the fact that debt to GDP had to go up from below 50% to almost 100% in the times of war, actually all other parameters of debt management improved. And that's something which we tried also to communicate, including the rating agencies and all other partners who do the risk assessment of the country, because the debt is high in the absolute terms and in relative to GDP. But what does it mean in practice? It means that the debt service went down from average rate of 4.5% on external debt and total average rate of 7.2 to the total average rate of 4.6 and the external one 1.9. This is a combination actually of concessional financing and the commercial debt restructuring, because the commercial debt was the most expensive part of external debt here. And in terms of the weighted average, which is also a very important factor because we don't want to be in situation post-war that immediately we will have to repay significant chunks of debt. So here the improvements even more noticeable. Pre-war, we had roughly similar average maturities on external and domestic debt. During the war, the domestic debt average maturity went slightly down, mostly because the international investors who participated in the longer end of the curve actually withdraw from the market, and domestic participants are playing somewhere between 1 year and 4 year horizon. So the domestic debt average maturity went down to 5.7 years, but the external one, which is the majority of the new debt accumulated, went up from 6.3 years on average to 15.8, which means that the bulk of the repayments will come more than a decade later. And that's really important achievement in terms of the debt sustainability and possibility to also attract resources for the rebuilding of the economy and for the post-war recovery. And if you move to the next slide, please. That's a couple of words about the domestic market. As I said, domestic market was really live and vibrant since the war started. So the war started, I think, on Thursday, and our first auction was next Tuesday already. So, and we had all the primary dealers in place, and we conducted since then on the weekly basis the domestic auctions. With the improvement of the macro situation and inflation going down, and actually decrease of our financing needs for 2026, we managed to bring down the borrowing cost as well, because if you look at those who follow at our weekly auctions, from the offering of each of instruments in the level of 5 billion hryvnias, which is roughly 100 million euros, we now moved to offering it in the size of 2 billion only, which created the excess of demand story and brought the yields down. We believe that the yield compression is very well correlated with inflation expectations, and we see that this trend continuing and helping a lot in the managing the debt service part. We also see that there is more interest to lock the investment in the higher yields. So there is roughly 100 basis points differential between a 1 year and 3 year instrument. And it drives especially commercial banks to lock themselves in the higher yields, also anticipating further cuts on the policy rate of the central bank. And that is reflected for this year. For example, you can see that the majority, 80% to be precise, of the inflows in February were to the instrument of the 3 to 5 years maturity. And everything else was a 1 to 3 years. So even on domestic debt, we don't resort to short-term borrowing, keeping the refinancing risk in control and trying to extend the maturities. We even now getting the feedback from the market that there is an appetite from something which is 4 or 5 years instruments, which is a good development for us because that helps us to smoothen the maturity profile even further. And we expect this market to continue. We're also thinking about already next steps. My discussions with the offshore investors show that there is increasing level of comfort in terms of looking at Ukrainian hryvnia bonds as it was pre-war. We have all infrastructure in place. You know that we're partnering with the Clearstream, which is a part of Deutsche Börse, in terms of maintaining all the links to Ukrainian market from international markets. So they're all active, and there is a technical possibility to invest is there. So nothing deteriorated with the war. The only thing which prevents, in my view, a new inflows to the segment from international investors is the capital controls. And because the total stock of international holders is below $400 million in total debt stock, so significantly less than all other categories of the debt holders, we believe that that's the right moment of time to start discussions with the IMF and the NBU about lifting of the capital controls as a prerequisite for the new inflow of the category. And we hope that this process can be finalized this year. On IMF, as you know, we expect the board approval of the new program today. And after that, I think it will be the right moment to start the discussions about the capital controls and the next steps in lifting. We believe that the government bonds should be one of the priorities in that respect. Christian, and you asked some questions about the debt restructuring. Indeed, we had in 2022, we agreed with the bondholders and warrant holders about standstill on all the payments. In 2024, we conducted the comprehensive debt restructuring of Eurobonds, which was one of the quickest debt restructuring in the last couple of decades, and very much driven by a good level of understanding between us and bondholders about the needs of the country and the needs of the contribution of each of the part for the financial sustainability. Last year, we engaged with the warrant holders. I wouldn't say that the discussion was in the same level of being constructive, but it took us more time. Warrants, by design, are very special instrument, very special instrument. We got rid of them already. So to remind to those who didn't follow the story, the warrant was the instrument which was issued in 2015, which meant that in any point of time when the GDP growth is more than 3%, we pay part of the GDP to the holders of the instrument. And it didn't work well when the GDP contracts by 30% and then rebounds by 5.2, as it was in case of 22 and 23. So we had to pay from the low base during the time of the war. So we introduced a moratorium on that payment, and we approached the market with a proposal to get rid of the instrument because, in our view, it was not designed for this type of situation, and it's definitely big burden for the future financing. We calculated that in case of economic recovery post-war, even in modest terms, the payout on the instrument were in the magnitude of $8 to $20 billion for the life cycle of the instrument, which had a maturity date of 2041. So we introduced moratorium and we approached the holders to restructure it comprehensively. After half year of discussions, we launched the deal in December and finalized the last days of December. So we converted all of the warrants to the new bonds, C series, which we call them, which will mature gradually from 2030. And those bonds are now being traded already and are on the market. They're obviously increased the debt stock, but we traded uncertainty, which potential huge payouts, to certainty of having one bond which is being out there, and that was the last important milestone in terms of the comprehensive commercial debt restructuring. So we expect the new IMF analysis to show that the debt is being sustainable on that basis, subject of not deterioration of economic conditions. And that's important also milestone to pave the way for Ukraine to reach the international markets once conditions permit. For us, we already see that improvement of the view of international investors allows the private companies to reach the market. Specifically, you saw that in January, MHP already printed the Eurobond, and the demand was so high that they actually did additional $100 million tap weeks after the initial placement. We believe that that signal on its own can be helpful for Ukrainian corporates, for example, who want to look at the possibility to raise money from the market. We will not be as a sovereign in a rush to explore this option on our own. For us, the concessional financing, when we can get something long and cheap, is obviously better than getting something shorter and more expensive. But it's important for us to have a choice, and for that, having all the prerequisite being implemented for the access to the market is crucial, and I think we largely achieved that already. So now the trading of Ukrainian Eurobonds is pretty much a reflection of the view on the war rather than any debt and sustainability on our side. And as you can see in the pricings on the secondary market, when any headlines war related actually impact the curve a lot. So that was also one of the major achievements of 2025 for the Ministry of Finance. I'm looking here that I'm speaking ready for more than half an hour, so maybe Christian, under your control, I can pause here and we switch to the questions. I see that there is something already popping up in the chat, but over to you here. Thank you so much.
Yeah, thank you very much, Yuri. Very interesting to listen and to see. And